Members, welcome to this video. Will Sebastian here on a Monday morning as we roll into markets. Our Academy members are full of energy and ready to go for another 5 Zoom sessions, one each day. Don't forget, if you want to trade with real traders, learn how things work with our strategy, it's very unique. Go underneath the video and you can start there. So hedging is something which I wanted to cover. Hedging makes the core part of our strategy. You'll be surprised to know we don't use stop losses whatsoever. We only encourage them for beginners. The reason why is because they're not necessary. As much as most people believe, you don't need a stop loss. I'm going to show you exactly why that is in this video. So you're going to learn tons. If you just heard no stop loss and panicked, trust me, watch the whole video, watch it all the way through, and you'll see exactly why it's the best thing you're missing out on if you're not doing it already. So essentially, when you hedge in any market, doesn't matter what it is, we're looking at a metal today, gold, XAU, USD ticker. You could be hedging a currency in the Forex markets. You could be hedging a stock index in futures. Doesn't matter what it is, really. Hedging is just a way to partially or fully cover yourself on open positions. So when you're exposed in the market, let's say you've got a short on gold, for example, like many of us do, you would look to be taking some of that long while you've got that short open, because what that basically allows you to do is hedge. Now, if you're in the US and places like that and you're under FIFO rules, it's still possible to do this. Lots of our traders do it. So it still works for you. But generally speaking, like I said, if you're, if you've got a position in the market, maybe it's short, hedging would basically be taking a counter position against yourself, be it on the same broker or another. And what that does is it effectively stymies the flow of that drawdown or the loss you're accumulating on that asset. Now, that's really important to do early. That's why our system relies on it entirely, because we teach traders how to manage their capital in a way via hedging, or what we call damage control, to stop the flow before it gets too much. I mean, it's been exactly apparent on gold, for example, because gold has rallied and rallied and rallied on increased sentiment bias to the upside. Okay, you've gone about 20%. And I said very, very early on, you really want to be careful here, because if you break the highs, I said it right at the high breaking, you're going to want to think about how you might hedge if the market keeps going up against you. Because effectively it's an artificial stop loss. When you're using a stop loss and you put your order in the market, okay, if the price gets to $2,130, for example, hypothetically, I'm going to trigger my stop loss. Once that stop loss has been hit, that's it. It's over. You can't do anything else, and you have lost the money. Okay, so that's why we don't use them, and we don't really need to, because instead of having a really large position with a stop loss and guaranteeing a loss, because we don't know when the market is going to stop via sentiment, we just hedge smaller sizes on the way up within that move to protect ourselves long term. So I'll show you what I mean by that. Now, gold particularly has been a market where it's been movement. You've gone up and up and up and up and up and up. And in many regards, you read most articles or what lots of traders are saying, it has moved counter to the way it normally does. Okay, the risk on market, which you've seen, for example, in the SPX for a long time, in this move to the upside, came at the same time as gold, traditionally a safe haven asset, rose as well. So while people were taking risks, they were also effectively putting their money in something safe at the same time. And that doesn't normally happen, really. But that's why gold has caused confusion for so many people. But with the tensions in the Middle East now, the sentiment bias has got a little bit clearer. But having said that, when it all started on Friday, gold dropped. Again, counter to what it normally does. So it's finding its feet really sentiment-wise. But even without that, in most cases, when you're going to need to hedge and use damage control early, it is going to come about at a time, usually when the sentiment or the mood of the market is very harsh in one direction. So like you saw with gold, that was exactly the case. The market sentiment and the mood was completely to the upside. And that's why it rushed and rushed and rushed against you. So it's all about doing hedging. Really, the purpose of hedging is to protect yourself in times when it's rampant and it's going far further than you thought it would. And remember, as I always say, the markets will do this. The markets will always go much further than when you think they will. But let's take a scenario here. Let's say this was your hedge zone trigger. Okay, you're going to say to yourself, and this is what I said to many members, if I short here, I can have a stop loss up there, which would have got wiped out, by the way, okay, because the market came this high. So let's make this entry black, red for the stop loss. So you would have lost money if you'd stopped. And if you just kept putting shorts with a stop loss, you'd just keep losing money. Okay, so stop losses are very ineffective in harsh momentum scenarios. In other words, when the market is flying and flying and flying against you, stop losses are going to fail. Okay, because it's very unlikely that the point you pick is going to be the one when it falls. Okay, so there's a better way, like I said. So let's say you shorted there with no stop loss. When the market comes up very slightly, that position is now out the money, isn't it? Okay, and what you get is you get all these micro movements, really small up and down. And this tends to happen very frequently, which allows us to make this strategy work. Now that looks a bit messy on this time frame. So if I drop my time frame down to the 1 hour and I just look at the market again, okay, this was about our entry point. What can you see? Well, what I can see is loads of different places where it was absolutely possible to just hedge long. Okay, and you could have exited all these hedge longs on a continual basis. Right? So you're not shorting again because you know it's risky, or at least if you are going to short, you're going to space it out. But you could have just bought on all these lower moves. Now, you wouldn't be buying the whole size. So if you shorted, let's say, I don't know, 5 micros, 0.05, then you might take part of that, 0.001, and just hedge to the long side. Get all the gains you can, kill off the former entry. Okay, so that is so much better when it's done on lower time frames in many cases, because you can see how many opportunities there actually are. To most people, they look at the weekly, for example, and they just see this and they think, wow, it's just gone straight up. Which it has, but if you drop to something like the 4 hourly, there's actually a lot of instances after you might have shorted, okay, around in line with 2145, where you could have actually bought and exited, bought and exited, bought and exited all the way up. And it often is the case that this happens because you're never going to have an asset really, unless it's been highly manipulated like the Turkish lira, where you get no dips on your lower time frames whatsoever, or even on your higher time frames. Okay, so what that does is it allows you to exit for long side gains there, and just keep killing them off when there's gains, and they're applicable, and you need to, you can just exit for profit. Now, it's not as easy as simply saying, oh, I'm just going to buy every single time it pops up. It's not like, you know, our damage control hedging plans come with many, many hours and weeks, months, even years for some people of training. Okay, it takes a long time to master it, but when it is mastered, it unlocks the door to success, because suddenly you can stop using those stop losses and you can hedge. So what's happening along here, to answer the question directly, you know, you might have typed to find this, exiting or placing hedges is basically where you're buying all the way up on all these, you can see where I've drawn these golden lines, you're long every time, because your shorts, if you took a short down here, for example, where I've drawn this black line, is now in loss. Okay, so your short is now in loss, but you haven't closed the loss. All right, because if you had a stop loss, it would have closed, right? And then these are all hedge longs, and you're counter trading. Okay, so basically you're buying in minuscule sizes, you're buying a part of your overall short that you've still got open. This reduces your exposure, and the profits you make from the long side you can use to extinguish the loss you might have on the short side. That is how we make money long term, and that's also how hedging works. And it's applicable in any market over any time frame, because this was just an example of how you could have hedged on lower time frames. I mean, if you go on to something like your euro dollar, for example, taking a real hit, we're long on these on the local pools, like we are on other dollar pairs. But if you look at something like this, when you really had a big market fall, when traders were treating the dollar as a safe haven within this inflation scare because they knew rates were likely to come up to handle it, you had all of this. Now, to a lot of traders, that would have liquidated them. They would have lost everything. That would have been it, because they didn't think the market could fall that far. But traders like us use this specifically. Now, note this time, we're not even looking at the lower time frames. We don't need to. But you could have just shorted every bump. Now, it's not the case that you need to do that straight away. I mean, you can get several long entries on before this and then use those short side gains to work out of those losses. Okay, so every single arrow I'm drawing is representing the short side where you could have short hedged. Okay, and if I just make this black, for example, you would have been shorting, because where I've just drawn that black arrow could have been a long zone. Okay, and all the red arrows afterwards, therefore, would have been your hedge shorts. So you would have looked to hedge each opportunity. Now, the hedges are coming on pushes to the upside and to resistance. Okay, even if you hedged early because you didn't think it would get that far, you would still end up in gains, because at each time, and in many cases for weeks, okay, look at this, 22nd of November all the way to Feb 22nd is sideways movement. Sideways movement when you're hedging for income to support your strategy is absolute gold. You'll notice if you scroll through various different asset classes, this occurs frequently. You get many instances where the market goes sideways, which gives you even more ammunition, okay? Gives you even more hedge gains, which is fantastic, okay? So bear that in mind. You can hedge all the way down on all time frames. Doesn't matter what you're looking at. Now, specifically as well, just as another example, like gold, if you were trading the SPX, for example, and I'm just going to add my moving average back, if it lets me. It doesn't like that. I'll do that at the end. It's not entirely necessary. I wonder if I can just duplicate one of these. It's being tricky. We'll do that at the end. So your SPX, for example, you're now crumbling down finally somewhat on a few aspects of fear in the market. But, all the way up, there was plenty of opportunities to hedge. Again, if you look at higher time frames only, you're never going to see them. You're not going to see these hedging opportunities if you stick to your higher time frames only. Because if I swap to my higher time frame now, it just looks like a straight line, doesn't it? It's just up and up and up and up away, with just one candle red there and there and there. And you're now at a hedge zone now where you can start to protect your exposure, okay, by taking positions within your former short trades you would have got long. So then again, you could have initiated it like gold when you broke this high, and you could have started to hedge this loss out early. And hedging early is always going to be the secret to a more viable long-term strategy. Because if you start to wash those losses away as quick as you can, in other words, if you get short and you start to get wrong, or you get long and you start to be wrong, like we saw on the euro, or like you might expect over here, hedging early by taking positions on lower time frames on dips to the upside, like you could have had here, it's going to be what stops you accumulating an existential drawdown. In other words, losing all your money because the S&P has gone up and up and up and up and up. So hedging is great. It lets you avoid significant damage, and that's why we call it damage control. So in short, when you're hedging, you're trading against yourself, basically, with part of your overall exposure. Okay, if you shorted one mini lot, 0.010, 10 micros, you might hedge 0.02 to the long side loads of times, take the money, extinguish what you got wrong. Like I said, you need full training to do that. We teach people every day live. We've got a fantastic academy who we're going to go live with on Zoom again today in several hours. Don't forget, it's underneath. Hope to see you on board. It's been great. See you in the next one.